The production output approach. The production approach is essentially the reverse of the expenditure approach. Instead of measuring the input costs that contribute to economic activity, the production approach estimates the total value of economic outputs and deducts the cost of intermediate goods that are consumed in the process, like those of materials and services. Whereas the expenditure approach projects forward from costs, the production approach looks backward from the vantage points of a state of completed economic activity. The income approach. The income approach represents a kind of middle ground between the two other approaches to calculating GDP. The income approach calculates the income earned by all the factors of production in an economy, including the wages paid of labor to labor, the rent earned by land, the return on capital in the form of interest, and corporate profits. The income approach factors in some adjustments for those items that are not considered payments made to factors of production. For one, there are some taxes, such as sales taxes and property taxes, that are classified as indirect business taxes. In addition, depreciation, a reserve that businesses set aside to account for the replacement of equipment that tends to wear down with use, is also added to the national income. All of this together constitutes a nation's income. GDP versus GMP versus GNI. Although GDP is a widely used metric, there are other ways of measuring the economic growth of a country. While GDP measures the economic activity within the physical borders of a country, whether the producers are native to that country or foreign-owned entities. Gross National Product, GNP, is a measurement of the overall production of people or corporations native to a country, including those based abroad. GNP excludes domestic production by foreigners. Gross national income, GNI, is another measure of economic growth. It is the sum of all income earned by citizens or nationals of a country, regardless of whether the underlying economic activity takes place domestically or abroad. The relationship between GNP and GNI is similar to the relationship between the production output approach and the income approach used to calculate GDP. GNP uses the production approach while GNI uses the income approach. With GNI, the income of a country is calculated as its domestic income plus its indirect business taxes and depreciation, as well as its net foreign factor income. The figure for net foreign factor income is calculated by subtracting all payments made to foreign companies and individuals from all payments made to domestic businesses. In an increasingly global economy, GNI has been put forward as a potentially better metric for overall economic health than GDP, because certain countries have most of their income withdrawn abroad by foreign corporations and individuals. Their GDP figure is much higher than the figure that represents their GNI. For example, in 2019, Luxembourg had a significant difference between its GDP and GNI, mainly due to large payments made to the rest of the world via foreign corporations that did business in Luxembourg, attracted by the tiny nation's favorable tax laws. On the contrary, in the US, GNI and GDP do not differ substantially. In 2019, US GDP was $21.7 trillion, while its GNI was 21.7 trillion also dollars. Adjustments to GDP. A number of adjustments can be made to a country's GDP to improve the usefulness of this figure. For economists, a country's GDP reveals the size of the economy but provides little information about the standard of living in that country. Part of the reason for this is that population size and cost of living are not consistent around the world. For example, comparing the nominal GDP of China to the nominal GDP of Ireland would not provide much meaningful information about the realities of living in those countries, because China has approximately 300 times the population of Ireland. To help solve this problem, statisticians sometimes compare GDP per capita between countries. GDP per capita is calculated by dividing a country's total GDP by its population, and this figure is frequently cited to assess the nation's standard of living. Even so, the measure is still imperfect. Suppose China has a GDP per capita of $1,500, while Ireland has a GDP per capita of $15,000. This doesn't necessarily mean that the average Irish person is 10 times better off than the average Chinese person. GDP per capita doesn't account for how expensive it is to live in a country. Purchasing Power Parity (PPP) attempts to solve this problem by comparing how many goods and services an exchange rate adjusted unit of money can purchase in different countries. Comparing the price of an item or basket of items in two countries after adjusting for the exchange rate between the two in effects. Real per capita GDP adjusted for purchasing power parity is a heavily refined statistic to measure true income, which is an important element of well-being. An individual in Ireland might make $1,000 a year, while an individual in China might make $50,000 a year. In nominal terms, the worker in Ireland is better off. But if a year's worth of food, clothing, and other items costs 3 times as much in Ireland than in China, however, then the worker in China has a higher real income. How to use GDP data. Most nations release GDP data every month and quarter. In the US, the Bureau of Economic Analysis, BEA, publishes an advance release of quarterly GDP 4 weeks after the quarter ends, and the final release 3 months after the quarter ends. The BEA releases are exhaustive and contain a wealth of detail, enabling economists and investors to obtain information and insights on various aspects of the economy. GDP's market impact is generally limited, since it's backward-looking and a substantial amount of time has already elapsed between the quarter end and GDP data release. However, GDP data can have an impact on markets if the actual numbers differ considerably from expectations. Because GDP provides a direct indication of the health and growth of the economy, businesses can use GDP as a guide to their business strategy. Government entities such as the Fed in the US use the growth rate and other GDP stats as part of their decision process in determining what type of monetary policies to implement. If the growth rate is slowing, they might implement an expansionary monetary policy to try to boost the economy. If the growth rate is robust, they might use monetary policy to slow things down to try to ward off inflation. Real GDP is the indicator that says the most about the health of the economy. It is widely followed and discussed by economists, analysts, investors, and policymakers. The advanced release of the latest data will almost always move markets, although the impact can be limited, as noted above. GDP and investing. Investors watch GDP since it provides a framework for decision making. The corporate profits and inventory data in the GDP report are a great resource for equity investors, as both categories show total growth during the period. Corporate profits data also displays pre-tax profits, operating cash flows, and breakdowns for all major sectors of the economy. Comparing the GDP growth rates of different countries can play a part in asset allocation, aiding decisions about whether to invest in fast-growing economies abroad, and if so, which ones. One interesting metric that investors can use to get some sense of the valuation of an equity market is the ratio of total market capitalization to GDP, expressed as a percentage. The closest equivalent to this in terms of stock valuation is a company's market cap to total sales or revenues, which in per share terms is the well-known price to sales ratio. Just as stocks in different sectors trade at widely divergent price to sales ratios, different nations trade at market cap to GDP ratios that are literally all over the map. For example, according to the World Bank, the US had a market cap to GDP ratio of 195% for 2020, while China had a ratio of just over 83% and Hong Kong had a ratio of 1.769%. However, the utility of this ratio lies in comparing it to historical norms for a particular nation. As an example, the US had a market cap to GDP ratio of 142% at the end of 2006, which dropped to 79% by the end of 2008. In retrospect, this represented zones of substantial overvaluation and undervaluation, respectively, for US equities. The biggest downside of this data is its lack of timeliness. Investors only get one update per quarter, and the revisions can be large enough to significantly alter the percentage change in GDP.